Hi, this is Aaron Fernstrom, Director of the Mayo Center for Asset Management at the Darden School of Business. We're here with Evrard Fraise at the 2020 Academic and Practitioner Symposium on ETFs and mutual funds. Thank you so much for being with us.
Thanks for having me, Aaron.
So we have a panel coming up this afternoon on which you'll participate on long goodbyes. But when we were reflecting just moments ago, it's not maybe always long goodbyes. Maybe we also have short goodbyes. I wonder if you could reflect a little bit on how your group thinks about these things.
Sure. So I work in the private equity group at JP Morgan. So I'm not a general partner. We are one of the largest limited partners in the world. So we're managing capital across the private equity spectrum in multiple strategies. So the question of a long goodbye is one that I think is near and dear to us as a limited partner, because we have obviously a strong focus on when we're getting our capital back, because we want to give that capital back to our own investors. So if a general partner is holding on to a security in the public markets for too long and not achieving a strong enough result to correspond with that duration, that's something we're not happy about. It's something that we would put pressure on our general partners to distribute or to sell down for us, because you're paying fees at the end of the day, and it's one of the issues that this paper investigates. Now, I think there's a few different issues here, and I think the paper is really hyper-focused on the LBO side of the market, so the large buyout part of private equity, where you saw significant companies come back to the public markets with very high ownerships from general partners. And there's some structural reasons why I think it takes them a little bit longer to sell their positions once they go public, because there's only so much the market can bear at any given time. But there's also some mechanisms that I think are in a general partner's toolkit. At the end of the day, they have a choice. They can give you cash or they can give you stock. When they're giving you cash, they're selling the position in the open market. So if you own 90% of a company and you were trying to sell that in one fell swoop, obviously that would be impossible, as you can imagine. They can do a block trade, or they can do a secondary offering. But all of those mechanisms at the end of the day have a liquidity discount. There's also a reality of how much the market will bear at any given time. So, and then there's restrictive legends, which might require them only doing a certain amount every 3 months or during an open window, et cetera. But they can distribute in kind, and when they distribute in kind, they can actually put a lot more out there in one fell swoop. But one of the things that we were just talking about before we started here is the irony is there's a tremendous disdain for in-kind distributions in the LP community. So many of our peers, endowments, foundations, pension plans, or other fund-to-fund type groups like us, just don't want to receive in-kind distributions. They think for multiple reasons. One, there can be a disconnect between their actual price, where they sell the shares they've received from a general partner, and the carry that they're paying based on this distribution price from a general partner. And then there's occasional abuses from a general partner when they're distributing in kind. But they're rare, but those are the examples that LPs remember. But as a result of all that, limited partners are putting tremendous pressure on general partners not to distribute in kind. And the irony from our perspective, and I think from an academic's perspective, if you're just looking at it agnostically, is you would find that the in-kind distribution is what affords them the maximum amount of flexibility in returning your capital to you as a limited partner at the highest possible price and the fastest possible way. And so you get around, I think, a lot of these issues that the long goodbye presents via an in-kind distribution. I think that's really going to be more of an education process, convincing limited partners that it is something that is in their interest and in their favor in terms of getting liquidity back faster and better.
Evrard Fraise from the Sands family grounds. Thank you so much for being with us.
No, thank you.